what's all this business about Goldbach levels?
In this video, I'm going to cover 5 powerful ICT concepts that can help to make you a consistently profitable trader. Now, on a trader's journey, the most frustrating phase is when you're in that break-even phase and you are trying to move to consistently profitable. Now, if you master these 5 concepts, you should be well on your way to winning more trades than you were previously. The most powerful ICT concept is the fact that price is booked by an algorithm. Before this became widely known, the previous school of thought was that price increases due to buying pressure and price falls due to selling pressure. Now, it is very difficult to become a consistently profitable trader if you have to predict whether buying pressure is going to be building or selling pressure is going to be building. But the fact that price is booked by an algo means that we can exploit the algorithm to be consistently profitable. Now, the algorithm, or exploiting the algorithm in its ultimate form, is known as Enigma. And I have my own exploitation of Enigma, which I call the time and price golden bullet. So moving to the charts, okay. Whenever you have a trade idea, I want you to ensure that it is supported by a higher time frame PD array. And going forward, every trade that you log, I want you to record the fact that whether your trade was supported by a higher time frame PD array or not. Now, the easiest PD arrays to use are the order block and the fair value gap. So if you see this price action here from Monday, the 9th of September, you will see that we have this down close candle here, which is your 4-hour order block. Okay, and this can be used as your higher time frame PD array. Now you'll see that this candle here is shaded in yellow. The reason being is I use this tool called the imbalance tool, and it just shows me where the fair value gaps are. Reason being is I do execute trades on the 15-second time frame, and sometimes it is very difficult to see those tiny fair value gaps forming when you're executing on such a low time frame. So this yellow indicator, the imbalance indicator, really helps with that. Okay, so you'll see that this piece of price action here, we had a wick into an order block. Okay, so that's the first concept. Make sure all of your trade ideas are supported by a high time frame PD array. Okay, the second concept I want to cover, and I just want to move the candles back so I can demonstrate this, is you really have to master the idea that price moves from external liquidity to internal liquidity. Now, external liquidity is typically a swing high or a swing low, and internal liquidity can include fair value gaps. So I want you to start thinking about this. The 2022 YouTube model that was introduced had a lot of ICT traders buying or selling any fair value gap that they saw. If you like using fair value gaps as your entry model, I want you to always keep in mind the idea of external liquidity to internal liquidity, and to only take that fair value gap entry if there has been a sweep of external liquidity beforehand. So if you see here, we have a swing high. Swing high formed, and we retraced into that 4-hour order block. This is external liquidity. Now playing the candles through very slowly, okay, you'll see that now we have a fair value gap that's formed. All right, but I do not want you to be setting your entries in these fair value gaps unless you've had a sweep of external liquidity first. Reason being is, if we are bullish, there is no reason for price to retrace down for us to give us bearish price action. It should not even retrace down to address a fair value gap unless it has swept external liquidity first. Okay, this should reduce your poor fair value gap entries significantly. Okay, so what we're waiting for is whenever we want to take a fair value gap setup, we have to remember external liquidity to internal liquidity. Okay, there we go. So at this point, we have now swept external liquidity, and you can call this a market structure break. Okay, at this point, you are now free to use your fair value gap entry. Okay, and whatever your target is. Okay, so that is the second concept. Understand that the algorithm should only retrace down to a fair value gap after a sweep of external liquidity. External liquidity to internal liquidity. Right. The third concept I want to cover is understanding that balanced price ranges increase the chances of your PDA supporting price. Now, what is a balanced price range? A balanced price range is simply where you have two fair value gaps next to each other. So you'll see that we have a bearish fair value gap here and a bullish fair value gap here. This is a balanced price range. A balanced price range supports fair value gap entries. Now, the fourth concept I want to cover under the heading of price is run by an algo is understanding the power of using multiple time frames to support your trade narrative. So going forward, whenever you execute a trade, I want you to ensure that you had a look at the H4 time frame, the H1, the M15, the M5, and then potentially the M3, the M2, and the M1. If you are an intraday trader, I don't think you need any other time frames. I don't think you need that daily time frame or that weekly time frame. You don't need magical time frames such as a 9-minute time frame or a 45-minute time frame. Okay, this is all you really need, unless you are scalping and you're going down to the 15-second. Okay, these time frames will give you more than enough information to see Enigma playing out. And whenever you are conducting your analysis on multiple time frames, it's critical that if you are executing on the lower time frames, you are in line with the higher time frame trade narrative. Now, I'm not saying you need to be in line with the higher time frame bias. Okay, you need to be in line with the higher time frame narrative. Now, the next powerful concept I want to relay is the fact that not all liquidity is created equal, meaning some liquidity is more powerful than others and moves the algorithm more violently than other pieces of liquidity. So if you go back to our example of sweeping external liquidity before capturing internal liquidity, you should start thinking about the times of these liquidities and how they're formed. Because if the premise is price is created by an algo, the algo will create liquidity at certain times for certain reasons. So this external liquidity here, if we put our time tool on there, we can see that it occurred at 10 a.m. Whereas the sweep of liquidity before we filled the fair value gap was at 1 o'clock. So what is the significance of these two time periods? Okay, now if we zoom in, you will know that the New York AM session typically starts at around 7 a.m. according to classic ICT teaching, and you can say it finishes around 11 a.m. Now, I use different times for my time and price golden bullet, but we can probably agree that this is generally the New York AM session. So the algorithm created liquidity during the New York AM session. And then when did it sweep it? Okay, it swept it at 1 p.m. Now 1 p.m. to around 3 p.m. And we can extend this back down to maybe 12. Okay, include some of the lunch, just for the sake of argument. This is the New York PM session. So a concept I really want you to start backtesting is, when does price tend to sweep liquidity? Okay, when does it do it? And what time does the liquidity that was swept usually form? This will start to help you to understand what is the correct drawn liquidity. And also, at what time do you expect that liquidity to be swept? Okay, so just to very quickly recap some important parts of the algo that really helped me to become consistently profitable. Number one, all of your trade ideas should be supported by a higher time frame PD array. Number two, you really have to understand the concept of external liquidity to internal liquidity. And in that way, you can really refine your fair value gap entries. Number three, understand that balanced price ranges support your fair value gap entries. Number four, try to use these standard time frames for your multi-time frame narrative. Now, you don't have to use all of them, but I would not use anything outside of this. Okay, don't use something like an M10 or an M9. Okay, the algorithm runs on certain time frames. Okay, and then number five, really pay particular attention to the times that liquidity is formed and the times that liquidity is swept. Once you've spent some time back testing this, this may increase your win rate anywhere from 5 to 10%.
What's all this business about Goldbach levels?